Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Just ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
The next lesson here in chapter 5, we are going to start putting everything that you've learned so far together. So this lesson is all about forecasting price action. And in this lesson, we're really going to kind of go over how to predict future price action, where the price may be here and there. So it's a really useful skill in technical analysis, because if you have an idea where the price may be going in the short and long term, you can use that to your advantage, and you can use it to help get your edge on the market. So using all of the price action indicators that you have learned up until this point, we will build on these skills in this lesson. Now, every trader uses their own set of rules for predicting price movements, okay? But all traders look for confluence in data to provide the basis for making their decisions. Now, designating these sets of rules or confirmations is typically what gives each trader their edge, as we went over, or their secret sauce, or their either successful or unsuccessful strategy. Now, indicators used to determine price action include, again, everything we've gone over so far in this entire course: support and resistance, technical indicators like the relative strength index, stochastic relative strength index, and the moving average convergence divergence indicator, trends, market cycles, fundamental analysis, you name it. Okay, moving on to the next one here. Okay. So a trader believes that it is possible to identify a trend, invest or trade based on the trend, and make money as the trend unfolds. Now, because technical analysis can be applied to many different time frames, it is possible to spot both short-term and long-term trends. So the first thing you're going to want to do is identify the overall trend. The first step is to identify this overall trend. This could be accomplished with trend lines, moving averages, or a peak and trough analysis, something we have not discussed in this lesson. Support, so you want to identify areas of support, and this says that areas of congestion and previous lows below the current price mark the support levels. A break below support would be considered bearish and detrimental to the overall trend if the overall trend is up. Now, resistance areas are areas of congestion and previous highs above the current price that mark the resistance levels. A break above resistance would be considered bullish and positive for the overall trend. Another one you'll want to use is momentum. So momentum is usually measured with an oscillator such as the MACD. Now, if the MACD is above its 9-day EMA or positive, then momentum will be considered bullish or at least improving. Now, buying and selling pressure is huge. So for stocks, crypto, and other indices with volume figures available, an indicator that uses volume is used to measure buying and or selling pressure. And then the final step to synthesize the above analysis to ascertain the following: strength of the current trend, maturity or stage of the current trend, your risk-reward ratio of a new position, and you're going to want to try to identify potential entry levels for a new long or short position. Okay, so while we cover how to determine specific criteria in the following chapter, it's important that you have a grasp on the concepts that should be incorporated into every trade that you enter. Now, once a trader has completed their TA and has identified potentially rewarding trade setups, there are some details that must be defined prior to entering into any trade. Okay, these details include your entry price, your exit price, or prices. Again, your entry price, there may be multiple, your position sizing, your stop loss placement, and a contingency plan. So you always want to have a plan B, C, and D, because things tend to change at the drop of a dime. Okay, so we've identified a potentially bullish chart in Bitcoin, and in order to take advantage of the forecasted price action according to your TA, we want to identify these targets that I mentioned in the previous slide. So the easy part here is technical analysis. The hard part is integrating what you've learned and integrating your technical analysis results into a profitable trade setup. So for example, you found a bullish chart pattern on Bitcoin and predict that the price may rise more than 100% upon validation of the chart pattern you have identified. Great. Now, how do you enter into this trade? Okay, so you know the price is going up. How do you trade this? There are so many great technical analysis out there, or analysts, but not everyone knows really how to trade, how to enter into price action, how to confront trend reversals, and spot trend continuations. So one thing you're going to want to do, your first step here, is identify your entry prices. So if your trade is a long trade, then you will ID prices that will potentially either be a pivot in the reversal, which means the last lowest low before the reversal to the uptrend, or a short-term reversal, or if buying a breakout, the point at which the chart pattern breakout is confirmed. Okay, so once you've identified your entry price ranges, you must then define your exit prices. Never enter into a trade position without your take profit levels in mind. Now, these values are also known as take profit or exit prices, and clearly defining these prior to entering into a trade will greatly improve your success rate. Just remember, you can never lose if you take profit. The exit price or the TP price must conform to a trader's risk management plan, something we will go over in detail in the next chapter, and fall within an acceptable risk-reward ratio, again, something we will discuss in the following chapter. Now, technical analysis will provide the trader with potential prices and the traded asset may reach in a defined period of time. Now, one way that we can trade or enter into a trade, there's many different ways to do this, but the one that we are going to use, which most beginner traders should start with, is the breakout trade. And that's what we're going to talk about in the next lesson. So let's move on.